Good morning, Tony. It's Shaq again. I'm glad we had a good session last week. And if you did get my materials, did you have a chance to go over the covered calls slide?
Absolutely.
And how did you like it?
Absolutely. And I got it. It was good. It looks like a fabulous concept. And the Google example was great, but I wanted to see how we could use that with the JNUG ETF that I'm having in my own portfolio.
Perfect. Now, tell me more about why you are long gold. Is it because it's cheap right now, or it looks like it's going to do something it might have done last year?
I always believe that you want to hold gold because obviously the uncertainty with what's going on with the dollar and the fiat currency.
Hmm.
So typically I like to hold gold just as a protectionary position.
All right, good. And just like you, a lot of investors share the same sentiment. However, they don't make as much money doing so. So what I'm going to show you is how to boost your returns, not only with covered calls, but develop a new system that leverages covered calls even further. So hang on one second. So I'm gonna quickly look at the example you have on JNUG. I'm gonna write on your screen. The stock today is at $11.38 or $11.40 approximately. You could sell covered calls and get approximately, let's say, 40 to 50 cents a month.
Okay.
All right. So this is your JNUG. I have the options chain up, and if you're doing the monthly calls, so the next one would be March monthly call options. This is the options you choose from. Now, it doesn't have half strikes, looks like. It looks like you could show the 13, 14, 15, 16 call. Now, if you do monthly calls, there's a greater chance the stock could go up to 14 or 15. So to play it on the safe side, most investors will choose a strike out there like the 14 or 15 to sell covered calls on. Uh,
Okay.
from what I understand, you have been selling the monthly call options and you've chosen the 15 call option for next month. Is that
That's
correct?
correct.
Perfect. So as you can see, I'm going to write it down. You are making 75 cents return on a stock that's at 11.52 now. All right, so we will change this to approximate this at 11.50, and your return on investment is 75 cents for the monthly call option. This is
Mm-hmm.
not a bad return. This translates to approximately 11.50 is going to be 6.5% return on your money. Pretty decent.
Yes, it's very nice, especially for a
Hmm.
month.
Now, what if you could double this?
That would be awesome.
Okay, let's do this. Now, because you are going so far out in time, it's causing you to choose a strike that's safe enough where your calls don't you don't get called out on your stock. Now, I'm
Right.
gonna because the beauty of options recently is you have weekly call options. You can choose a weekly call option to short. In this case, realistically, we will choose, let's say this week, a dollar away would be the 12 and a half strike. So between 15 and 30, let's say you have 20 cents of premium. Now remember, this week only has 3 more days to go, and therefore, usually this is approximately 30 to 40 cents. So even taking this example, let's use a realistic example from next week and we'll discount it. So 12.5 call from next week.
Okay.
Mid-market price would be approximately 50 cents, but let's take 40 cents to be on the conservative side. So 40 cents, and
this is for the February 24.
expires next week.
February.
Mm-hmm.
Okay.
Ideally, you wish to be doing this on expiration day on a weekly basis, and that's why I'm taking 40 cents instead of 50 to project values, which will most likely be around 40 cents. Looking at this, you're going $1 away from the current price of the stock, and you're getting 40 cents premium on a weekly basis. Now, some weeks you'll get 40, some weeks you'll get 50, some weeks you'll get 30. If you average it, let's say you got 40 cents on a weekly basis, conservatively. 40 cents times, if you get 40 cents times 4, how much is that?
$1.60.
Okay, so that's an average of 40 cents. You're getting $1.60 per month. How much of a return is that compared to the 75 cents?
Just on the call side, looks like it'd be about 13.8% per month.
13.8%. This effectively increases your return, almost double, just by doing weeklies. Yes, you are taking more risk. However, it's a calculated risk where if it does go, if you do get called out, you're willing to sell puts. Now, this is another portion I want to talk to you about, is boosting it even further. Now, when you do weekly call options, the chances of you getting called out may increase. Therefore, what I complement this with is selling puts at a level I'm comfortable buying the stock. Now, if the stock's at 1160 right now, I'd be very comfortable selling a strike, one strike down, or $1 down. This would be the 10.5 call, and the mid-market price between 35 and 80. Let's take 55 cents. Let's round it to 50 cents. So simultaneously, apart from selling weekly calls, you'll be selling weekly puts, because given the risk of you getting called out, you'd also like to sell puts and increase your likelihood of owning an extra 1,000 shares. So 50 cents from your puts. Now you could do this on a weekly basis. You could also do it on a monthly basis, but I would suggest weekly. So you would get 50 cents if you shorted this on a weekly basis. Now some weeks you'll get 50, some weeks 40, some weeks 60. Let's average it to 50 cents and add it to this. So 50 cents, that's from the calls, this is from the puts. Times 4, that is approximately $2. Now that $2 equates to how much on a 1150
Right around 17%.
investment?
Yeah, right around 17%.
17%. Perfect. Now add the two. The 13.8%, let's say 13% from calls and 17% from puts. How much do you get on a monthly basis as opposed to the 6.5% of just doing covered calls?
That would be about 31% between the two.
So let's round it up, be conservative, 30%. A little bit more risk, but you're doing this already on a monthly basis. Did you see how much you boosted your returns?
It's substantial.
Yes.
Absolutely substantial.
Here's the key. Every expiration Friday, which is every week now, you'd be buying back the calls that expire that week Friday for a nickel or two, most likely a nickel. You'll be buying back those calls and puts, and you'll be rolling it to the following week. And you'll get a head start because there's more premium to short. There's more theta over the weekend. You'll be shorting, and you'll be getting a better return. And the reason you're buying back is you're covering your risk. You'd have to buy it back before you could short the following weeks. And doing so, it'll give you a head start on the following week, and you would get anywhere from 10 to 15 cents extra on your premium just because you did it a week before rather than Monday. So don't let your calls expire or your puts expire at the end of the day on Fridays. Just buy it back if it's trading for a nickel or two and get a head start on the following week, and you'll have more premium to short. Okay?
Okay, and if it's not, if it's going to get caught, what do I do? If it gets caught away, it just gets caught away, correct? There's nothing.
All right, if it gets called away,
or should I?
let's say this week you get called away because you shorted the 12.5 call. That's fine. You could buy stock again and get started again for the following week, or you could aggressively sell puts. So you sold the 12.5 call. Now you can go ahead and aggressively sell the 12 put or 12.5 and hope to get put into stock. But most people, what they do is they just buy an extra 1,000 shares. That's if you get called away. Now, what if you end up buying extra shares because of your short put? So this week you shorted the 10.5 put, and the stock went down to 10.40 at the end of the week, and you ended up with an extra 1,000 shares. Now, in that case, you could turn around and sell the 10.5 call to get rid of that extra 1,000 shares. You could go ahead, sell the 10.5 call. This way, essentially, you selling your stock at cost basis, but your options will probably return you anywhere from 85 cents to $1.10. So approximately $1 return on your options for just selling the stock at the price you bought it. So if you get put into stock by selling the puts at 10.5, you will sell the 10.5 call aggressively to get rid of that extra 1,000 shares. You will keep the other 1,000 shares, and for that, the other 1,000 shares you could sell the 11.5 call as a regular covered call that you've been selling. So you just do this on a weekly basis, and you've seen just with 1,000 shares, the returns are phenomenal, isn't it? On 1,000 shares, we calculated your investment is $11,500. You used to get $750 on a monthly basis. Now you're getting a 30% return, so close to $3,500 just from doing this strategy. This essentially pays, this $3,500 a month essentially pays for itself or the stock in 4 months if you play it right. Now, the beauty of this is, remember the client I talked to you about, you spoke to Alex? Alex has been doing this on the FAS, and the FAS stock has gone from $20 to $43 recently. So his stock is appreciated. Let's say JNUG also appreciates. Today it's at 12.5, but in the past, last year, it's been all the way up to $30. So if you keep doing this, not only you could potentially make money on your stock, but it will pay for itself with some income on a monthly basis.
And at 30% a month, or even if it's 15 to 30% a month, that's extraordinary.
Conservatively 15%, and if you're pushing yourself, you could go from 30 to 40%. So those are the numbers, and that's the beauty. It does take a little bit more work. Instead of 1 hour a month, you'll be doing 1 hour a week. Is that something you could afford? Is that something you could afford to make an extra 3,500?
I think I can handle that.
Okay. All right, Tony.